Today's episode, we're going to be diving into FOMC. If you go to the Fed Watch tool, you'll find that there is a general consensus that they'll increase the current rate, which is sitting at about, I think, 475 basis points or 4.75%, 4.5 basis points to 4.5 by 25 basis points, getting us right up to about that 5% level. Now, why is this of interest to us here at 0-DTE? Well, I'll tell you. Of course, interest rates are where it's at. That is what's causing the primary volatility that we have in the market. And volatility is a central thing to being a premium options collector. And that's primarily what we do. We put on asymmetric premium collection strategies that are for that very final day of expiration. We're taking the smallest amount of time with the most rapid rate of decay of premium of options on the SPX index. And that's how we gain an advantage. Now, when we have something like the Fed out there causing all kinds of ruckus, well, that helps us because that really rises the level of volatility that's out there, that inflates premium, that gives us much better pricing on the strategies that we use to collect premium. We get in at better prices, less risk, more potential reward, all's good. So that's why we're so interested in that. And we do a particularly unique form of 0-DTE trading compared to the way most other people are doing it. And if you look at most other retail services that are out there, they're generally putting on like an iron condor, super wide spread, like 5 or 10 delta. And they're putting it right smack dab in the middle at the money, hoping to collect a tiny little bit of profit by taking a huge amount of risk. And generally, those strategies, that's exactly what they do. They collect tiny little bits of profit, and then they're taking huge risk every day. The risk is so big, in fact, that they don't even allow themselves the full width of that strategy that is supposed to be like a 95% probability. So what they'll do is they'll cut it short with stops. They're only taking really a 65% probability that they'll be in profit before they get stopped out. That seems just crazy to me. And the reason why they do it is that their gamma risk is so high that if price tends to move away from that center point where that at the money strike, then almost immediately they're in the red, and in the red by some huge amount. Most of these trades are going after or putting up, say, about $1,000 of risk, going after maybe $50 of profit. And so you're sitting there trying to collect $50, and all of a sudden you find yourself $200, $300, $400 down and potentially going to lose $1,000. You freak out. And so what you do is you get out of that trade as soon as you can. Well, most of these strategies have devised the idea that they just put in stops to prevent that from happening. And of course, in these days, at least in the past couple of weeks, they've probably done okay because the movement in the market has been relatively small most days. But we've also had some gargantuan moves, and those are the days when those strategies have just completely lost it. Now, for us, those big moves and even the small, medium-sized moves can be profitable, the big moves particularly. The small moves, not so much, because we're really looking for a directional movement. And the way we present these trades is that we're generally taking an out-of-the-money butterfly, and we'll put it way out of the money. We'll take a very, very wide butterfly, and we're looking for an asymmetric return. And so by pushing it very far out of the money, we're looking for a tiny little bit of risk for a very large return. As an example, we might put on a 30 wide butterfly. Now, if that butterfly didn't cost us anything, there's a potential of $3,000 of profit in that butterfly. We push it far enough out so that our risk to reward is approximately 10% of the width. So our cost of that trade is about $300, right? Or $3 to a 30 wide. So that's what we're looking at. Putting up a small amount, let's say, just to put it in equal numbers, if they're going after 100, we're going after 3,000. If they're putting up 1,000, we're only putting up 100. So that's the big difference. So essentially what we have is an opportunity that is anywhere from 20 to 30 times more cost efficient or more efficient use of your capital. Yet our win rate isn't that much different. So if they're going for a 65, 70% win rate, we're around a 50% win rate, but our return is 10 times as much. So what that results in is very little drawdowns, small drawdowns, very tightly controlled equity curve so we don't get a lot of volatility. Our equity isn't going all over the place, and steady, sustained returns. And we never are in a position where we're scared or concerned that we're going to lose a big amount. Our risk is already well defined, so we never have to worry about that. So when we go into an event like tomorrow where we're expecting huge moves, those don't concern us at all. As a matter of fact, we say, hey, bring it on. That's exactly what we're looking for. We relish the chance to get into one of these high volatility situations. As a matter of fact, in a way, you can say that our service, our strategy is anti-fragile. And if you know the concept of anti-fragile, that means that the more stress that is put on a system, the stronger the system gets. And that's exactly what we're like. When we have stressors put on our system, we get stronger. So more volatility, we get stronger trades, more profit, more consistency.